advice. Let's talk about the advisory space. And a new report from Advisor Ratings has found that advisor outflows took a breather in the quarter, but overall numbers continue to slide. To tell us more is Mark Hoven from Advisor Ratings. Mark, good to talk to you this afternoon.
Good afternoon.
All right, yeah, who'd want to be an advisor right now? It is a difficult period, but I guess people want to look longer term. But just talk us through that. What's going on at the moment as far as that space is concerned, because we are seeing those numbers continue to fall in terms of the number out there because of further rationalisation in the industry.
Yeah, the numbers have been falling for quite some time. We've commented on this show previously about that decline, and it's been driven by a whole range of factors. Obviously, the increased regulation over the last 2 or 3 years have added significant costs to what it takes to run a business, the complexity of maintaining compliance, meeting all those obligations that the regulators demanding of advisors, and running those businesses profitably whilst continuing to invest. So that's been a challenge. Educational standards, forcing advisors to go back to university and school, has meant that many have decided not to follow that pathway and have left for those reasons too. There's a whole range of sort of headwinds that have been confronting advisors and been very, very well chronicled.
Yeah, and I noticed you're also looking at reclassification as far as licensees are concerned. Why is that?
Yeah, so in this particular report, we've spent a lot more time looking at the licensee sector and the structure of the licensee market, and that's a natural thing to be doing. Advisors, at the end of the day, are employed by advised businesses, but more importantly, under the Australian structure, authorised under licensees or licenses. And so there's been a lot of debate about the future of the advice industry. A lot of that discussion is also focused on the structure of that licensing model. So the reality about the licensing system, though, is that it's heavily skewed to the top end. Something like 60% of advisors are authorised under the top 15% of licensee companies. And actually, even if you look at the top 300 a little more closely, 3/4 of those advisors are under the top 50 licensees. So it's a really, really top-heavy concentration. So those businesses at the top end are big, larger, they're growing because the banks have been exiting wealth. A lot of those organisations are not banks now. They're diversified non-bank organisations, and they're investing in their systems. They're growing their advisor pools. And so we need to drill in a little bit further and look at these. Are these businesses going to be strong enough to sustain themselves over the next few years? Can they invest? Have they got the balance sheets? Have they got access to capital? And where does that start changing as you go down that sort of top 100 to go deeper? Where does it become more concerning? Where are the risks lying in terms of the financial stability of these firms? There's some of the things we're looking at, and part of doing that is to actually chop up that industry into homogenous groups that are comparable. So we've chopped up the licensee market into a new segmentation that allows us to speak a little more intelligently about those licensees by their nature. So we've got banks, we've got diversifieds, which are generally organisations that are running multiple business lines, advice lines and non-advice lines, product manufacturing, for example. And then you're getting into the limited license space, which is very much dominated by the accountants, and then down into the small privately owned space with sort of 1 to 10 to 50 advisors.
And just briefly, Mark, as far as customers are concerned, are you seeing any shift there, depending on which sector they're seeking an advisor from? Obviously, advice is so readily available, particularly individually. If you just want to turn to the internet, you could be overwhelmed, but also in these times of great volatility.
Look, again, I think empirically and anecdotally, we know that the demand for advice is growing. People really have come through COVID-19. So I think everybody's been impacted in some way financially and economically. And so I think that's driven a lot more interest in the advice space. As you mentioned, though, I think a lot of people are still somewhat, scared from going to get a full financial advice plan, and so are looking at digital offerings. And in between that, in between the digital and the full face-to-face comprehensive advice solution, is what we often call, in the industry, or officially it is called limited advice, scaled advice, or simple advice, or even episodic advice. These are all different terms for it, but it's where the real demand seems to be growing. And I think the industry is going through a real existential crisis, trying to understand how can it service this demand. It's trying to re-engineer itself. Government's driving a lot of narrative and discussion around how can we reduce red tape, how can we give advisors the confidence to deliver this kind of advice, but not run foul of the laws and the compliance obligations they have at the moment. So that's where the demand's coming from, and that's the kind of way that we need to service that.
Mark, that's interesting. Thanks very much for joining us on Ausbiz today. Mark Hoven from Advisor Ratings.
Thank you.